Next is Natacha Valla, doyenne de l'école de management et d'innovation Sciences Po Paris. Donc Natacha, c'est à vous.
Thank you very much for the invitation. I'm really honored to be here because President Draghi is my president by heart. I'm a central banker by career, and thanks to him, I went back to Frankfurt at the time when we thought we would tighten monetary policy, but we ended up loosening it for another decade. And I have to say, this report that came out in the past few weeks was honey for us at the National Productivity Board, which I'm honored to preside, because the National Productivity Boards of the member states of the Monetary Union, you have to know that it was the initiative of a report back then, which was called the Five Presidents Report, which was looking already at competitiveness, at productivity, but in a context that was really, really different from what we know today, in particular in the European context, where Germany had a strong surplus, countries like France had a strong deficit. We had issues related to relative unit labor costs. We were all looking at the same charts, diverging charts of relative unit labor costs, and things have changed a lot because the things we look at right now are more related to what we can do in common to become collectively more competitive. What are the relative advantages, but how can we pool them? So we read this with a lot of interest. And so today, when we prepared the session, we had Philippe gave the overarching view of the key elements for competitiveness today in Europe. We also had the detailed picture of where the productivity weaknesses in Europe and the slowdown of productivity came from. We have the recipe of how to create a DARPA in Europe, which is a real-life example, and I think that's really encouraging. So I thought I would focus more on some elements for an industrial policy and the role of education in this. Those elements will be featured in some way in the forthcoming report, annual report of the National Productivity Board. It's not published yet, but I think some elements will be part of it. So I will say three things, basically. The first one is that the strategy we can have in mind for industrial policy. Remember, a few years ago, industrial policy was a gros mot. We were not able to mention it. It was something that we were not allowed to think of in terms of economic policy and in terms of possible strategy, and that has changed very deeply. So industrial policy, what are the options and what are the pros and cons, and what is possibly the most favored way. Second set of elements on the role of education for a proper and successful education policy. And then finally, how to finance it. Some elements were mentioned, but I think the landscape, in particular the fact that the bank-based financed ecosystem being diversifying itself, that creates new opportunities, perhaps also new challenges, but opportunities to create financing for scale-ups and for innovation in the European context. So starting with the strategies of industrial policies, I think, and that was clear from President Draghi's report, there's a spectrum, right? And there could be one extremity of the spectrum which is related to a fully fledged, strategic autonomy, the pure prototype of something that would, protect us from developments and uncertainties in the global economy. I think this is a bit of an ideal type, which is not so realistic. And the other two options are one, focusing financing on a couple of key sectors, strategic sectors, and I think that's the sense of the remarks by Philippe Aghion earlier, the fact that we're able to pool resources to support the sectors that we want to focus on. So I would say that would be a preferred model where the advantages are relatively clear. We are able to scale, to concentrate resources. Remember, Europe is big, but it's as big as it gets. In particular, when you compare the size of its economy with the equity valuation of the big players in the innovation sector. On this, we are also able now to have, and we've seen that with Antonin's facts, we're able to have a more granular analysis of where the low-hanging fruits in terms of productivity lie. We are looking at this at the National Productivity Board, and we are able to identify the branches and the sectors that are a drag on productivity. We also are able to identify the reasons why, and Banque de France has published very good analysis on this, but the sectors that, for example, in these countries, those are retail trade, those are construction, services in real estate. When you sum them up, that's quite a big chunk of GDP. So it gives you an idea of where, if you want to boost productivity and channel financing, even beyond the long-term impacts on innovation and potential growth, for short-term reasoning, there's a way to fix things and kickstart the engine. And the other dimension advantage of such a strategy is indeed the speed of impact on productivity and therefore on competitiveness, and also the fact that we would be able to create leaders, global leaders that are able to compete on the global scene. Of course, you also want probably to create some resilience in global value chains. We've seen that some shocks were really unexpected, and you might have to end up in a sort of second-best realistic environment. And this is the more risk management aspect of industrial policies, right? Even if the first best would be to focus on those productive sectors, those sectors at the frontier, for risk management purposes, you may want to put some of your, means in, I'm not saying in financing, making sure that Doliprane is produced in France, but perhaps a little bit of it still, and therefore to secure the value chains to reduce the vulnerabilities. And on this, we can use a degree of flexibility. Again, we're looking at this for the upcoming reports at the National Productivity Board, and we see that we can be a bit opportunistic on this as well, right? The global landscape, market shares in global trade are changing. The role of China, the place of China is declining. Within the monetary union, the relative position of economies are changing. Mind you, France is becoming again price competitive on some sectors, and those sectors being industry and manufacturing. So price competitive relative to Germany, that's a bit of a scoop, and that creates some room for opportunities. Now, the recommendations that stem from this analysis are fairly straightforward. So I think I'd move now to the link between the industrial policies and the role of education. And here again, I think only by browsing the literature, recent and less recent, brings out a number of key sort of stylized facts, right? I'll list them. I have 4 or 5 of them. One, human capital is a driver of productivity. The OECD does an exercise of simulating the impact of an improvement of a country's PISA results. You know, the PISA results are the ranking of a country in terms of literacy and numeracy, the skills of our kids, basically. And if France were to become at pair with the 10 best countries, productivity would go up by 2.7%. So I mean, there's a number of analyses like this. So this is sort of a known fact, but also vindicated by the numbers. The skills level is also very strongly correlated by productivity. This is beneficial to value added by our work, but also beneficial to the individual in terms of career trajectory, in terms of the quality of the jobs that are available to workers, etc. General education, we'll speak a lot about innovation, the frontier, science, STEM areas, but general education is also an area which we should not undercover and underestimate. And finally, soft skills, and we produced that in our report last year, the role of soft skills and management skills, that was mentioned a little bit in the case of Germany. That matters, and that matters also for the ability of firms to innovate and for the productivity growth at the firm level. This is something we document with survey-based analysis, but this is fairly robust. So here again, the recommendations for education policy with respect to the desirability for industrial policy are fairly straightforward. Focus on literacy and numeracy. Focus in particular for innovative sectors on what we call STEM in France, right? Science, technology, engineering, and mathematics. Lifelong education, that's also an element. I mean, if we drop this, and I have to deal with it every day at Sciences Po, we have to think in one side of our brain about, you know, the education that we give to students who just got their A level, but then we have to think about the education that we give to professionals. But they connect all the time, and they will connect more and more. And professionals mean what? 5 years of professional experience, 10, 20? So we have to think of it as a continuum. I think institutionally that's not going to be easy, but as an impact in terms of accessibility and flexibility of access to the education system will help a heck of a lot in terms of being successful. I'll shift to my last point, which is the financing of industrial policies. What we see, and that is very well documented in President Draghi's report, private savings is abundant in Europe. It's unfortunately invested in, well, not so low yielding, but a bit higher than before, but still relatively low yielding fixed income instruments issued by the US. It would be better employed in Europe on productive areas. The non-bank financing, and this is something that is less directly observed, but you know there's been an increase in private debt instruments, an increase in private equity, the broad place of private equity, and this is becoming more and more polarized. This is growing fast, but becoming more and more polarized. On the one hand, on large tickets, they want to finance big firms. They don't want to finance those weird in-between growth in the growth scale-up firms, or they want to go retail. So they want to get the money of retail investors, mainly households, exploiting in that way the sort of regulatory loopholes that we have on those actors. So that means, you know, as a direct way to allocate saving, it's not going to be directly invested in the areas that need financing the most. So as a recommendation for the financing, and this relates very directly to what is in President Draghi's report, and I have 6 recommendations and I will stop here. One, of course, having a common debt in Europe is something that could be very desirable, even if politically that's difficult. A more consensual element would be to adapt the mandate of national promotional banks, the EIB, the EIF, the EBRD, the Banque du Conseil de l'Europe. There are many institutions that have a AAA issuance and that should be able to allocate funds better according to the thinking around an industrial policy. We could put in place systems of guarantees, first-class pieces, things that don't eat so much capital on the side of public finances. I think those recipes have been thought of to finance innovation in the past, but you know, organized around a common view on industrial policy would be very powerful. A sovereign fund in Europe would be obviously another options, and public-private partnerships for infrastructure are also a valid option. Thank you very much for your attention.